let me cue this up. I'm just queuing it up. Okay, I see myself on the, oh, this is helpful actually. I can see it being broadcast over there. My head is out of the picture for some reason. Oh, there's a delay. Let me zoom out a bit. I pinch it out to zoom out. No, it's pinched as far as it can go, I think. Yeah, it seems to be out, it's zoomed out as far as it can somehow. Okay, that's up more, downwards this way. By the way, it's just to let you know it's live. There's my head in the picture. I'll come over here. Let's see if the board's still in the picture. Bottom of the board. Bottom of the board's a little bit out of the picture. Let me raise the board a tiny bit. See if it's better now. I'll try to edit this out of the final video if I can do. Okay, it's not perfect, but I think it will work. Okay, so I'm just going to take a 5-minute break. 5-minute break. I want to know, can you hear me? Can someone put a comment? First of all, Happy New Year. I hope you all had a good break or are still having. And can you put a comment if you can hear me? If I'm audible. Wish I could turn on the sound on my own thing to see if I'm audible. Alright, I seem to be audible. Please comment if you can or can't hear me. Hi. Anyone willing to comment? We have, oh, it's in the waiting stage, I see. So it's not, it may not be broadcasting yet. Okay. I'm just going to assume it's working then. So I'm just going to get a breath of fresh air. Be right back. About 12:10 to 15. Okay, that's right. I'm just going to take a step outside. Feel free to weigh in with any questions or comments. I don't know if anyone's hearing this, actually. Okay, let's give this a try. Has it started yet? I don't see who's here. How can I see who's here? It should have started. It says 3 waiting. I don't know what that means. Is it? We are live, it says, yeah. Let me check on my other device here. Oh, it says 20 people are here. That's good. All right, let's get going then. Oh, there's a comment here. I think... Oh, I'm not seeing the chats. Hi all. I think you need to change the top chat option to live chat to see the live update. All right, that's very important, so let me do that. Okay. How do I do this? I don't know these things. Pop out chat. Yep, there it is. See both of these things at the same time. Oh, no. Weird. Top chat. Live chat. Huzzah. All right, we've done it. Happy New Year, everyone. Okay, so let's get started without further ado. Hope you all had a good holiday, and yeah, hope you're doing well. It's always strange to be having a conversation with one's self. All right, anyways, let me get going. Just clean the board here. Thanks, Philip. Okay, there we are. Let me get started here. All right, I'm going to start with the risk aversion question. So this is from the mock exam, part B, question 2, part F. Okay, now, I won't be able to, I'm going to just do my best to sketch this out, maybe get some feedback from you. There's many ways to answer this question, and to fully cover it, one would have to revise all the material from, most of the material from the uncertainty chapter. But let's dig into it, and I'll give you my impression. Oh, okay, am I not loud enough? That's not great. Am I too quiet? Can someone weigh in? Is it too quiet? You're on my side. Okay, well, I guess I'll just speak loudly. And yeah, sorry it's kind of quiet. I apologize. Okay, so question F. So just to recap where this question is coming from and how it fits in, there's in part B, there was one question that you had to answer all of, that was question 1. And there was one question, question 2, that if you choose this, you have to choose 2 parts of it for up to 25 marks each. And F was one of those. F was 25 marks. Okay. So the question says, it's asking for a lot of things here. It's a very demanding question. It wants you to define risk aversion. Then it wants you to explain why an economist would advise a risk-averse investor to diversify her investments. It's asking you for more things, and you have to do all of these things. But obviously they're all tied together. Okay. How do we define risk aversion? Does anyone want to volunteer a rough answer to that? What would be a definition of risk aversion? Even a casual one. So I'm asking you to give me proposed definition of risk aversion. Yes, Patrick, that's a good answer. Given the same expected value, one always prefers a certain outcome to a risky outcome with the same expected monetary value, and one always prefers less variance or less spread of the outcomes to more spread of the outcomes. Another way of saying it is that a risk-averse person will never be willing to take a fair bet. That's maybe like you might think of that as the building block of it. A risk-averse person will never be willing to take a fair bet. And if we assume people are expected utility maximizers, risk aversion will result from an individual's utility of income increasing at a decreasing rate. So that relative to any point, so this would be utility of income, and the person's an expected utility maximizer, so the person chooses to maximize expected value of the utility of some gamble y. So if it has two possibilities, it could be the probability of the low outcome times the utility that they would get from the low outcome plus probability of the high outcome, which would be 1 minus probability of the low outcome times the utility they get from the high outcome. That's an expected utility maximizer, at least with two outcomes. Yes, so Cindy, you're right. Risk aversion will result if the person's an expected utility maximizer and they have this utility of income that is increasing at a decreasing rate, diminishing marginal utility of income, so that a gain of income of a certain amount adds less, relative to a particular point, a gain of income of a certain amount, let's say 1 unit, adds less to utility than the loss of utility from a loss of income of that same amount. In other words, this difference in utility from a gain of 1 is less in absolute value than this distance in utility from here to here from a loss of 1. And of course here it's perhaps not so easy to see because the slope is only subtly changing, but you'd certainly see it on such a diagram if I made the change bigger. You could certainly see that this distance is less in magnitude than this distance here. Okay? So if the person's an expected utility maximizer and perhaps they were asked, do you want to take a 50% chance of this gain in exchange for a 50% chance of this loss? Because the gain from the gain is less than the loss from the loss, they would say no. So here's some somewhat formal, somewhat intuitive ways of defining risk aversion. Okay, let's go back to the question. So we've defined risk aversion in one of these ways, formally, informally, intuitively. Explain, next part of the question, explain why an economist would advise a risk-averse person or risk-averse investor to diversify her investments. Okay? So what do we mean by diversify? Well, just simply, rather than investing all in one asset, or all in one category of assets, perhaps, invest that same amount, divide it between different baskets, divided between different assets. So rather than investing it all in oil or all in computers, invested half in oil and half in computers. Okay? Um, or, if we think about it more abstractly, perhaps rather than betting it all, if you have to bet on coin flips, these coin flips are to some extent in your favor. So it's not double or nothing. It's if I win the coin flip, if there's a heads, I double plus 1%, and if there's a tails, I lose. Don't bet it all on one coin flip. Divide it up between many coin flips. So if I, instead of betting it all on my whole 10,000 on one coin flip, I bet 5,000 on each coin flip, well then, rather than having either 20,000 or 0 with 50% probabilities, I then have 0 with a 25% probability. Sorry. I then end up with 0 with a 25% probability. So if I've lost both coin flips, I'll end up with my initial amount, or I'll win one and lose one half the time. So I could either lose one and win one, or win one and then lose one. And I'll end up with my initial amount, or perhaps my initial amount plus a little bit more. If we said that when you win, you double it plus a little, and when you lose that amount. So if I lost once, if I bet it 5,000 each, if I lost 5,000 once, and I gained 5,000 plus a little the second time, I'd end up a little bit better off than where I started. And then the remaining 25% of the time, I would win both coin flips and end up with 20,000 plus a little more. If it's a coin flip where I win a little bit more than double when I win, or I win a little bit more than my initial investment when I win. Okay, so that outcome for someone who's risk averse would be better than an outcome where you keep roughly your same amount half the time, lose everything 25% of the time, and gain everything 25% of the time, is better than losing everything half the time and gaining everything half the time for someone who's risk averse. I gave you the example in the lecture that if we make lots of these binary coin flips, so rather than betting everything on one or half on two, then I move to betting a quarter of everything on 3 coin flips, etc., etc. If I divide it up into very small units, that converges to something called the binomial distribution. And we saw, again, if you look at the lecture notes, that if you divide up the income into many, many coin flips, the probability that you lose more than a certain amount, for instance, the probability you lost something like more than 5%, is rather small. Okay, I don't want to go afield here. So, explain why an economist would advise a risk-averse investor to diversify her investments. Okay, how can I explain this? Well, I could give the depiction of the 2x2 case from the text and also from the handout. So I could say, here's an example of diversification. So either bet it all on one coin flip, or put all in one investment, or divide evenly between 2 investments. So if I say, so if I have 2 investments, now the key thing is that these 2 investments must not be perfectly correlated with one another. So if one investment always performs well when the other performs well, and always performs poorly when the other performs poorly, then the diversification has yielded no value, because then half the time you'll lose with both, and the remaining half of the time you'll gain with both. But if the two are uncorrelated, sometimes one gains when the other loses, and vice versa. Sorry, not uncorrelated, but not perfectly correlated. Sometimes when one gains, the other loses. Then diversification will reduce the spread of your outcomes. Okay, so if I bet it all on, let's say oil and transit are both coin flip risks. I have 35,000 to invest, and I need to invest. I have 35,000 to start with, and I want to invest 15,000. Okay. A share in each firm costs £1, and for each firm there's a 50-50 chance that the share will rise to £2, that is double its value, and a 50-50 chance that it falls to 0, that is lose all of its value. If I invest the full 15,000, and so suppose I say invest in one, invest in either just one of the two, let's say just oil, then that gives me income of 35 minus 15 when oil loses, so 20 with probability, I'll use this for with probability 1/2, and 35 plus 15, or 50, with probability 1/2. Okay. On the other hand, if I were to put 7,500 in each, so let's say invest 7,500 in each, then there's 4 possibilities. Sorry, okay, then there's 4 possibilities. So half the time, let's say how oil does. Oil does poorly or well. Transit does poorly or well. So suppose that the probability here is 1/2, probability here is 1/2, and these probabilities are these two events are completely uncorrelated. So the conditional probabilities, if you like, are the same as the unconditional probabilities. So each cell has probability 1/4, and I invest 7,500 in each. So I end up with, both of them lose when I flip 2 tails. So I get 35 minus 15, so 20 with probability 1/4. Half the time, either oil does well and transit does poorly, or vice versa. So there I ending up break even. I end up breaking even. So I end up with my original 35,000 with probability 1/2, and I end up with 50,000 with probability 1/4. In other words, 1/4 of the time, both will do well. I will flip 2 heads on these investments. Okay, you could compute that the expected values here are the same. The expected monetary values are the same. So what's the expected monetary value of 20 half the time and 50 half the time? It's simply 1/2 times 20 plus 1/2 times 50, which is equal to 10 plus 25 is equal to 35. What's the expected monetary value of 20 1/4 of the time, 35 half the time, 50 1/4 of the time? Well, that's just 1/4 times 20 plus 1/2 times 35 plus 1/4 times 50, which you'll see is also equal to 35. So the expected values are the same. So now let me just fill in these cells. So we have, here we have, if they both do poorly, 20, if they both do well, 50, otherwise ending up where we started. Okay, so using utility of income graph, I could show that this outcome is better than this outcome. We also know just by definition that the person being risk averse will prefer this outcome to this outcome. Because this outcome is the same as they'll prefer this outcome to this outcome, because this outcome is the same to this outcome, but it takes away a quarter probability from here and adds it to here, takes away the other quarter probability from here and adds it to here. It moves risks from something in the middle to something at the extremes, holding the expected value constant. So if I was to draw this on a utility of income diagram, if the person is risk averse, which we usually model as them having diminishing marginal returns, here's income, here's the utility of certain incomes. Let me give this a better curvature. Usually holding my elbow constant is helpful, but never making it slope downwards. So this is income. So this is the 35 they started out with. If they put their eggs all in one basket, as we say, or if they put it all in one investment, they'll get 20 and 50 with equal probabilities. Okay, this is utility of certain incomes here. Let me just make this axis, just call this utility. So of course here, this person would be better off not investing at all. But the example would transfer to a case where these investments actually yielded a positive expected return. The same argument, given that they're yielding a positive expected return, less variance is preferred. Okay? So in the first case, where you put all your eggs in one basket, you end up with 20,000 half the time and 50,000 the other half the time. When you get 20,000, your realized utility, dash it over here from this utility of income, is this amount, utility of 20. When you get 50, your utility is the utility of 50, dash it over to here, u of 50. What is my expected utility? Or if the person's an expected utility maximizer, how much do they value a 50% chance of this and a 50% chance of this? Well, it's simply, so the expected utility of the gamble, let's call this y tilde, I don't know, 0, just y tilde, let's just call y tilde, equals, where y tilde is equal to 20,000 with probability 1/2 and 50,000 with probability 1/2. The expected utility there is the probability of the first outcome, 1/2 times the utility of the first outcome, which is just u of 20. I haven't given you a function for this utility, plus 1/2 the utility of the second outcome. The probability of the second outcome times the utility of the second outcome. Okay, so it's basically halfway between here and here will give me their expected utility of this more risky gamble. Now we know that to find the point between here and here, well, we can just measure between here and here, but there's also a useful graphical intuition, which is, and this is just geometric, if I were to draw a straight line, a little bit difficult, but draw a straight line between here and here, and go any share of the distance between here and here, project up to this diagonal line, project over to here, that will tell me the same share of the distance between here and here. Constant slope. Okay, so if I go half the distance between here and here, that takes me to 35. I project up to here. I then take this point, I project over to here, and I get the expected utility of this gamble. Okay? And I can, by the way, compare it to the utility of the certainty. It's less than the utility of the certainty. Okay? Now, so this is why this certainty would be preferred to this gamble. What about the diversified investment? Well, with the diversified investment, you didn't end up here half the time and here half the time. You ended up here a quarter of the time, here a quarter of the time, and here half the time. Okay? So half the time, so half of the value is the value of getting this half the time and this half the time. And we can see where that point is by constructing these 2 points, going halfway in between, dashing over to here. So half of the time, when one of the investments does poorly, in other words, the expected value of the investment is here. The remaining half the time, one of the investments does well. Then half the time you're here and half the time you're here with a value over here. Okay? And then, so we then have the diversified investment is like getting this value half the time and this value half the time. And we also know, so what the point halfway between here and here, you can get that by dashing a line there, projecting up from the distance halfway between here and here. Sorry, this gets a bit intricate. I don't want to highlight it too much. I think you can look at it on your own. There's a discussion of it, I believe I put in the text. So that would have, so the diversified investment then has this particular value. And you can see that this point is indeed above this point, as you would imagine. And there would be other ways of explaining this we explained previously. All right, let me get back to the question. I feel like I've digressed a little bit. Okay. So, why would an economist advise a risk-averse investor to diversify her investments? Because she can, by diversifying, she can attain the same expected, given the expected return, she can achieve lower variance, which implies greater value. So rather than, I could think about drawing a histogram on top of this. So rather than getting this half the time and this half the time with the same expected value, she can get, by diversifying somewhat, she can get this a quarter of the time. Here, these bars represent the probabilities. This a quarter of the time, and this the remaining half the time. Okay, and if these were all positive expected value investments, this would just all move up a tiny bit, basically. Okay, so, and we know that her being risk averse, these have the same center point, but less dispersion. We have mass here, probability mass here instead of here. This is something she would perceive as better. And we've also shown this using the utility of income diagram. Okay, but we want to answer this whole question here. So let's make sure we got all of it. Okay. So this is generally why a risk-averse investor should diversify her investments. But let's think about it a bit more in answering the rest of the questions. Would the advice be the same? I see I'm going a bit long on this one. Would the advice be the same for any risk-averse investor, or would it vary depending on her level of risk or would it vary depending on her level of risk aversion? Well, by this logic, any investor who's even a tiny bit risk averse should diversify. Okay, so an economist advises investors to always diversify. Okay, does this depend, or economists advise a risk-free investor to always diversify, that is, if there's assets that she can buy with, let's say, roughly thinking about the same expected return that are uncorrelated to each other, split your money between those. Okay, but there's a little caveat to that which comes up in the next question. Does this depend on whether she can borrow or lend at the risk-free rate? Can she borrow and lend at the same rate and at the same rate as every other investor? That's the assumption behind this basic capital asset pricing model. Explain why or why not, referring to equations and diagrams as needed. What are the implications for the returns to risk in an efficient market considering the capital asset pricing model? Let's return to our handout on this. Okay, so everything else equal, the risk-averse person should diversify if they have these assets to choose among that have, let's say, the same expected return, but they're not perfectly correlated to another. But will those assets arise from a market? We think about efficient markets. We think about investors bidding up the prices of assets, or bidding up or down the prices of assets that are expected to pay particular streams of return. Okay? Which assets will pay which returns? How much variance will there be to those returns? And how will the expected value of those returns, like an asset might be expected to return 5% per year, how does that relate to the variance of that expected return? So an asset might be expected to return 5% per year, but it might have a standard deviation of 20%. Another asset might be expected to return 1% a year, but it might have a standard deviation of only 5%. How should the market come to that? Well, that's what the capital asset pricing model gets at, and I want you to have at least an idea of the general principles of this. Okay, so I'm skipping over the options contract and the value of options right now. So the text presents the idea that there's a trade-off, the Nicholson and Snyder text, although I would advise you who are doing finance or who are just generally interested in this to read more, basic articles even on the foundations of the capital asset pricing model. That's the key asset pricing model. So the textbook introduces the idea that there might be a trade-off between risk measured somehow, perhaps variance of the value of the asset or standard deviation, a similar idea, of each asset. So each asset may have a certain risk, and everyone might anticipate what this risk will be, and a certain expected return. You can think about it as percent, they say annual return, percentage increase per year, expected percentage increase per year. Okay, and every particular asset might have some risk and some return. That is, if I buy this asset, I can expect that its standard, it has this much variance, however you want to measure variance, and this much return, maybe 2% per year on average I can expect. And so here's all the risk and return you can get from individual assets. And then they draw something called the market line. And what this represents is if I choose in a certain most efficient way to allocate my bundle among all these assets, and then decide to borrow or lend at the risk-free rate, I can achieve any of these possibilities in terms of risk versus return. And remember, I want less risk and more return. So, and in fact, what it works out is that by buying, if all investors are doing this, what it works out, I'm not giving you the full explanation because it's not a finance course, but you could look into it. If all investors are doing this, what works out is that the best thing each investor can do is to buy each asset in relationship to its value, to its share of the market, which will take them to a buying, and so divide out my portfolio between all of these assets in proportion to their value, which is determined endogenously, in fact. And that will put me at a certain point, which will be on this line, and then there will be a certain interest rate, and by either leveraging my investment, that is borrowing money and investing more, I can move in this direction, I can move along this line of more risk and more return. The slope here simply reflects this constant, this linear way in which borrowing more and investing more will increase my risk and my return, but or not investing everything in this asset, but investing some of it in the risk-free asset, we used to say treasury bonds, you can just think of the bank, will reduce both my risk and return. And then I could achieve any point on this line. Okay? And I cannot achieve any point above this line, and I can never achieve any point above or to the left of this line. Remember, risk is bad. And I can perhaps achieve a point below or to the right of this line, but I would not want to do so. Okay, because for risk averse investors, they'll have indifference curves that look something like this. Okay, and there's a diagram in the handout. Different risk averse investors may choose different points, but they will all choose a point along this line if they're risk averse. And they'll all buy basically some share, unless they're extremely risk averse, some share of this, what we call the market basket. They'll put some of their money in this, just buy everything in proportion to its value. Okay, let's get back to the question to see if we've sufficiently answered it. Would the advice be the same for any risk averse investor? Yeah, essentially. Diversify, buy the market basket, and then borrow or lend at the risk-free rate. If buying the market basket, which lands me, I think we said at this point here, if at this point I would be willing, you could think about the indifference curves, to trade off gaining some risk to gain some annual return, then, suppose this was my indifference curve, then I should then leverage myself a bit, but still diversify and then leverage. Does this depend on whether she can borrow or lend at the risk-free rate? In fact, yes, it does. We've assumed she can borrow and lend at the same rate, and that's the risk-free rate, so she can put herself at any point on the frontier of things that people can achieve that they would possibly want by buying this bundle and then borrowing or lending at the risk-free rate. Buying some share of this bundle and borrowing or lending at the risk-free rate. If she can't do so, then, in fact, so suppose she bought the market basket and then decided to leverage a bit. Well, in fact, if she was paying a higher interest rate, then to borrow money, she paid a higher interest rate, then in fact it wouldn't take her to this point, it would take her to perhaps some point here, and if she wanted less risk than that, well then it wouldn't take her to a point here, it would take her to some point here. So it's possible that, so this depends on being able to borrow or lend at the risk-free rate. It's possible that if an investor is not that risk averse, so they're willing to take on certain more risk than this to gain return, it's possible that they might in fact then do better with a different combination of assets, perhaps still diversifying than what they can achieve. It's even possible that perhaps a single asset might put them at a point above what they could achieve by diversifying and borrowing or lending at the risk-free rate. It doesn't seem likely, but it's possible. All right, finally, what are the implications for returns to risk in an efficient market considering the capital asset pricing model? What I mean is what sorts of risk will be rewarded. Okay, will more risky assets tend to have a higher annual return? So remember, the risk return in the market is determined by these assets' price is bid up or down by investors who know they can diversify. Okay, and I'm not going through the whole capital asset pricing model, but I want to just give you the basic principle here. Okay, so these investors will say, okay, I can diversify. So if you have an asset that is very risky, but its risk, in fact, is uncorrelated with any other asset, then I can essentially, and if there's presumably lots of assets like that, they're uncorrelated to one another, I can sort of fully diversify away that risk. We saw this with the binomial distribution. As you divide it into more and more baskets, the distribution becomes narrower and narrower around the center point. It's a little bit low there, sorry. You can fully diversify that away. So in fact, that sort of risk, that sort of coin flip risk, doesn't amount to risk once I do diversification. That doesn't amount to risk in a diversified portfolio. But there's another type of risk. We know that we talk about the stock market does well, the stock market does poorly. We speak about it in general. So in fact, the values of these assets, or the returns, the actual returns, how well the company does, how much dividends they can pay, the returns will be somewhat correlated to one another. That's called market risk. And assets that have more market risk, I can't simply, or assets whose fluctuation is more correlated to how the market does, you cannot simply diversify away from that risk. That's a risk you will have to take, and thus that sort of risk, assets with that sort of risk need to generate a higher annual return in order to justify their price. Therefore, their price, or if they're paying a stream of dividends that fluctuates a lot, that's highly correlated to the fluctuation of everything else, that's less valuable than a more certain stream of dividends. I can't diversify away from that risk. The asset price will be bid down, making the return greater. So in general, the relationship, if I were to draw a line through these, the relationship between risk and return for each asset, it should be a positive relationship between the market risk and the return, not between the idiosyncratic coin flip risk. Okay, I realize I went in too much detail on this, given the time constraints, so I want to move on after you ask any clarification or questions. So I'll give you a few moments to post any questions here, and then I'll move on to the next problem. Okay, so that's not a question about this particular question. So if we have time, I'll get to question 7, option C, or you could ask it on the formative assessment. Okay, well, why not just ask that quickly? Just ask me your question, and I'll give an answer quickly before we move on, just to get some interaction here. So go ahead, Guan Yuzu. What's your question? Question 17, by the way, is consider how prospect theory differs from the standard theory of expected utility. Which of the following are correct? Choose all that apply. Okay, and so you'll have between 1 and 5 correct answers. And the more correct answers you put, the better your mark. The more incorrect answers you put, the worse your mark, the lower your mark. And option C says, under EU theory, an individual must be always equally risk averse, risk loving, or risk neutral when considering a gamble relative to any level of wealth. Well, under PT, prospect theory, an individual can be very risk averse starting from a low level of wealth, but then less risk averse or even risk loving when starting from a higher risk level. Okay, and the answer to that was not one of the correct answers. That was false. And the explanation that I put was under EU theory, an individual can in fact have any risk attitude, and it need not be constant for all levels of wealth. So we've discussed risk aversion. What we really meant was global risk aversion. A person, no matter their level of wealth, would never be willing to take a fair gamble. But there's nothing in this theory that rules out an individual having risk neutrality, risk loving, or having their, so this is their utility of income, having this curvature change at different levels of income. This is completely acceptable by standard utility theory. So, given that, do you have a follow-up question on that, or need a clarification on that, Gonju? Oh, good. I'm glad it was helpful. Okay, so let me move on to what I had planned to cover. Thanks for your question. Next, and this will take some time, hidden information in the principal agent setting. Okay, but it's something important for me to cover. And it's largely computational, and it's something we, did a little bit towards the end of the module, so maybe you haven't had too much time to revise. Okay, so let me just clean up the board, and I'll dig into that one. So this is part B, question 1 from the mock exam. So if you were to have chosen this question, you would have to answer all parts of it for a total of maximum possible 50 marks. Okay, this question is about hidden information in the principal agent setting. If you choose this question, answer all parts. Consider a standard hidden information agency problem in which a principal hires an agent. Define a contract as a pairing of a transfer T and an output level Q. Okay, the principal hires an agent. The principal will set a contract where if the agent were to produce a certain quantity, they would get a particular transfer. The principal offers a menu of one or more contracts. A menu. So in other words, an agent can choose, perhaps the agent's presented a menu, and they have just one option on it, and then they can say, I will take that option, or I will go home, take it or leave it. Or the agent must say, okay, I will produce that quantity in exchange for this transfer. Or there might be several items on the menu. It might say, you can produce 10 units and I'll pay you 20, or you can produce 20 units and I'll pay you 28. And then they have to decide, the agent has to decide, do I take either of these options, or do I just go home and not participate at all? Okay, the agent knows her type, theta. This is the agent's type, and I'm giving you, in general, I gave you the general case, but I'm giving you a particular numeric case. The theta can either be here, 1 or 2. This will represent a parameter of the cost of production. Okay, the probability that the agent is of type theta is equals to 2 is 2/3. We'll call this the high cost type. So we could say little p probability of high cost type is equal to 2/3. So probability of the low cost type is equal to, obviously, the 1 minus the probability of the high cost type if there's 2 types, which is equal to then 1/3. The principal, already said that. Okay, this is her private information. In other words, first we're assuming, or we're considering the possibility that the agent knows whether she's low cost or high cost, but the principal does not. For a given contract, so we have contracts T, Q. If you produce Q, you are paid T. The agent's utility is the following. Okay, so what is the utility of the agent? And we can think about this as just one way of thinking about it would just be the agent's profit minus their cost of production, but their cost of production might also be an effort cost. So we could think about it as leisure time, whatever. There's various ways of justifying it. That's not important right now. So we have the utility of the agent is equal to the amount they're paid, so it increases linearly in the amount they're paid, T, minus theta Q squared. We can think about this as the cost of producing Q. So in fact, to be a little bit more complete, I could say the utility of the agent, or if they produce Q and they're paid T, is equal to the following. Okay? We can think about this as a cost of production, as I said, and it seems to be a cost that increases in quantity at, by the way, knowing this is squared, at an increasing rate. Okay. And the principal's utility, or profit if you like, the utility of the principal is simply equal to, here we're assuming the principal's utility increases linearly in quantity in, let's say, money terms, because it costs their utility or profit. The more they pay, the less profit they have. The more that's produced, the more profit they have. Okay? So generally, for these problems to have interior solutions, you either have to have the benefit of output increasing at a decreasing rate, and so the quadratic, and costs linear, or not necessarily quadratic, increasing at a decreasing rate, concave, and costs linear, or costs or benefits linear and costs increasing at an increasing rate. Otherwise, you won't have an interior solution, as you can imagine. That's an aside. Okay, now we got this set up. Now let's do part A. 15 marks. Suppose the principal can observe the type of agent before offering the agent a contract. Solve for the contract that the principal will write and find the resulting payouts. Okay, so I've taken a step back. I said we're imagining that this is the agent's private information, but now I say suppose the principal actually observes it. So it's no longer the agent's private information. This is going to be a fairly standard case. An agent comes into my office. I know the market conditions they're facing, or I know their cost of production. Okay, suggested answer. So what is the contract the principal will write? Suggested answer. We're calling this the full information case. Full information case. Okay. The principal is going to want to maximize their profit or their utility, or we could say their expected value of their profit. They want to maximize that. Okay. So they want to maximize Q minus T. They're going to choose Q and T, but they can't just choose any Q and any T, right? They can't say produce an incredibly high amount and we'll pay you nothing, or we'll have you pay us, because the agent wouldn't take that. You have to get participation. Okay, so there is a constraint. What is the constraint going to be? Well, for an agent of a particular type, I know what type they are, so an agent of a particular type to want to accept the contract, it has to be better than their outside option. Since we haven't said anything else, let's assume the outside option is to get zero utility. So in other words, the constraint, so the principal will want to maximize something subject to constraint. The principal will want to maximize, this is very, very trivial, or somewhat trivial, maximize Q minus T. They're going to get to set Q and T, subject to the constraint that T minus theta Q squared is greater than or equal to 0. Okay? Clearly this constraint will be binding because Q is good and T is bad. So I don't want to offer more T than I have to for the principal. So I don't want to offer more T than I have to, and I want as much Q as I can get. So in fact, it's going to be binding. So in fact, it's going to be the case that that the principal will set T equals to theta Q squared, so that this will equal 0. Okay? When the principal knows what agent they're facing, so this is in fact a separate maximization problem for each theta. So to be more precise, I could say maximize, well, let me just leave it here to save time here, okay? So knowing that this constraint binds, I can just substitute it in. So generically, when I'm facing an agent of type theta, I want to maximize Q minus T subject to this, but I can just plug it in. So in other words, I want to maximize, all right, Q minus the amount I have to pay is theta Q squared. So I get to choose Q to maximize this. T's disappeared. I know how to maximize something like this, all these things being positive. How do I maximize this? Anyone want to chime in? How do I set Q to maximize this? So Cindy asked about a participation constraint. So this here is the participation constraint. Right? You have to pay them enough. So for an agent of type theta, I have to pay them enough so that utility of the agent, for choosing, I'm in fact going to offer them a single option, is at least as good as their outside option, which we'll say yields them utility 0. So in other words, T minus theta Q star equals 0, so, or greater than or equal to 0, so I have to have T greater than or equal to theta Q squared. I said star, I meant to say squared. Okay, but answering the question about how do I maximize this, this is now an unconstrained maximization problem. I've substituted in the binding constraint. And we know what this looks like. It's going to be a concave function. So I just take the first order condition, derivative of this with respect to Q, set it equal to 0. So I get 1 minus 2 theta Q equals to 0. So I get, so to just rearrange this, I get Q equals 1 over 2 theta. And this is a generic solution for whether or not theta is equals to 1 or 2. And if you look at, so in other words, if I encounter the high type agent, high cost type agent, I should say, I will set, so and here I call this, I label this as Q first best as a function of theta. Why first best? Well, we'll see that the principal is making a trade-off based on true costs and true benefits, so they will assign first best outputs, maximizing social surplus. So Q first best of theta is simply equal to, as I just said, 1 over 2 theta. And what about, and so if I have a high cost type, for instance, I'll say, okay, I will pay you, if you produce 1 over 2 theta high cost, so that's 2, so QHC first best, sorry, let me use the notation of the text of it that I've already used, Q first best of the theta high cost, which is equals to 2, is simply equals to 1 over 2 times theta high cost is equal to 1 over 4. And similarly for the low cost, we'll see Q first best for the low cost type is going to be 1 over 2 times 1, or 1/2. And then we can also compute the transfers for the low cost type and the high cost type agent under first best. in general, we know what the transfers have to be. Theta times q squared. So for instance, so in general, this is q first best. So transfer first best in general as a function of theta is equal to theta times q first best, which is just times q first best squared, which is equal to 1 over 2 theta quantity squared, which is equal to, we'll square the inner quantity, we get 1 over 4 times theta squared. So then putting it together, we get theta times 4 over theta squared. So we'll get 1 over 4 theta. I don't know if that's visible on the screen. Yeah, it just is. Okay. And I could similarly plug it in for the high cost and the low cost. Okay, but let's make sure that we're answering all parts of the question. Solve for the contract that the principal will write and find the resulting payoffs. Okay, what contract will the principal write? I'll just erase this. We have it in our notes. If the principal knows the agent's type, when they see that the agent is of the low cost, they will say, okay, your contract is, so your contract is you have to produce Q low cost first best, and you will be paid T low cost first best. Sorry, keep the notation the same. Q first best, theta lower bar, and be paid T first best, theta lower bar. And we could make this a forcing contract. In other words, we could say, look, I know your cost. Either, let's just say it's a take it or leave it, okay? I'm not going to get into forcing contracts, okay? So take this or go home, okay? And we know what these things are. We've just solved for it. So we say, if you produce Q first best of theta lower bar, which we've just solved for is equals to 1/2. So we say Q equals 1/2. You will then be paid T first best theta lower bar. You'll be then paid a transfer of 1/4. So if theta equals theta lower bar, and similarly, if theta equals theta upper bar, just substitute in theta upper bar here, theta upper bar here, and that's Q equals 1/4. So they're producing less, their costs are higher. And are they being paid more or less? Well, it could go either way. They're being asked to produce less, but their costs are higher. But here, it turns out that, in fact, the net effect is that we pay them less. T equals 1/8. And this is efficient. Okay, when we looked at the first order condition, the principal was trading off true costs to the agent, or the marginal of this, against their true benefit of the output Q. Okay, but have we still answered the question? There's one thing missing. What have I forgot to say? What have I forgot to give you? Look at question A. It says, find the resulting payoffs. Just checking if anyone's still here. Yep, plenty. Okay. It says, find the resulting payoffs. So I haven't told you the resulting payoffs. And I give it here in the notes. I'll have you have a look at that. I think that should be straightforward. Payoffs yield 0 surplus to each agent. How do we know that? Well, I just paid each agent enough to give them 0 utility, to get them to participate. I said, high cost type, I know your cost. You've got to produce, I'm going to ask you to produce 1/4, and I'm going to pay you 1/8. Okay, let's see. If the high cost type were to produce 1/4, it would cost them theta is equal to 2, It would cost them 2 times the square of a quarter, that's 1/16. 2 times 1/16 is 1/8. So just as we set it up, they're just being paid their cost. They're being left with 0 utility. Similarly for the high cost type. What about the principal's profit? Well, we can compute the principal's expected profit. We know the probability that each type come about. So the principal's expected profit, we can say, is U first best for the principal, their profit or their utility, is going to be 1/3 the probability a low cost type comes about. The quantity that they demand for the low cost, let's say our first best quantity, minus the amount they're going to have to pay the low cost type, plus 2/3 probability they get the high cost type. They choose QHC, they pay them THC, and we have numbers for all of these things, plugging them in. So this was 1/2, this was a quarter, this is a quarter, this is 1/8. Plugging that all in, adding it all up, we get 1/6. Okay, so now we fully answered the question. But we haven't really gotten into the interesting bit about asymmetric information. This was the benchmark case, the setup. Okay, so I'm going to move on to part B, unless there are any clarification questions. Moving on to part B. Now assume that the principal does not observe the agent's type, but knows the probability of the agent being of each type. Okay, so in other words, you don't observe whether they're low or high cost type. You only know there's a 2/3 probability they're high cost and a 1/3 probability they're low cost. Find the optimal menu of contracts for the principal to offer. Find the resulting payoffs. Remember to check shutdown and pooling contracts. Show how you obtained your answer. Oh, this is helpful. You do not need to give a proof of which constraints bind and which are slack. You can merely cite a general rule. Okay? So previously I just specified the participation constraint. Incentive compatibility was not an issue because I know which type of agent I'm facing and I offer them one contract or go home. That's the participation decision. But now I don't know which kind of agent I'm facing as the principal, so I'm going to offer a menu of contracts, and hopefully each agent will choose the contract that I want them to choose, that I intended them to choose. Okay. There's 4 constraints in general, so we have the participation constraint of the high cost type. T minus theta high cost Q squared has to be greater than 0, or greater than or equal to 0. We have the participation constraint of the low cost type. Okay, so let me flesh this out a bit. So I'm going to offer a menu of contracts. So I'm going to say you can choose to participate. If you choose to participate, if you choose to be hired, you can choose between these 2 things. THC, so the transfer intended for the high cost type, you'll be paid this amount if you produce QHC, or you'll be paid this other amount if you produce this other quantity. Okay? And as we'll see, or at least we saw in a general sense when we went through the algebra, this quantity will be higher than this quantity. But the agent then says, okay, do I want to accept this contract at all, participation constraint, and given that I've accepted the contract, which of these 2 do I want to choose? Do I want to choose the one that was intended for me or the other one? Basically, you can think about the intuition for this. When I'm considering one of the constraints, participation or incentive compatibility, I can basically assume the other holds, or assuming the other holds, does this hold? And then I check the other one, assuming the first one holds, does this hold? And if both of those answers are yes, then they both hold. So there's 4 constraints in general. Both types have to participate. and both types have to choose the contract element intended for them. I stated, and I gave you some logic and intuition, which you might find interesting to revise. For why, in fact, only two of these constraints will matter if we're trying to get both types of agent to accept the contract and to produce a positive but distinct amount. The two constraints that will matter are the high cost type's participation constraint and the low cost type's incentive compatibility constraint. If we set transfers and quantities such that these two hold, the others will automatically hold. Okay, so all we need to worry about is getting the high cost type to participate, to produce some amount, and getting the low cost type not to choose the amount intended for the high cost type, but to choose the amount intended for her, the low cost type. Right, so what are these constraints? The participation constraint of the high cost type is in general that THC, the amount we want the high cost type, we want to pay the high cost type, the amount we pay her, minus her cost of producing, like let me say, let's call this cost for the high cost type of producing the amount we assign to the high cost type, has to be greater than or equal to her outside option, which we'll say is 0 to keep things constant. Okay, but we have an expression for the cost of the high cost type of producing. Okay, in fact, we just stated an expression for, let's make it simpler, for her utility from accepting the contract being paid a certain amount and producing a certain quantity. So if she was to produce, we're looking at the participation constraint of the high cost type. So we say, okay, what will the high cost type get if she accepts the contract and does what we intended her to do? Remember, you assume the other constraint binds. She will get THC for producing QHC. Her utility of that is her benefit of this minus the cost of producing this, and we've said it's T minus theta Q squared, specific to the high cost quantity and transfer. And in fact, we know her, we said for this example what her value of theta was. It's 2. Okay, for her to participate, this has to be greater than or equal to her outside option, which we said, let's just call that 0. So this is the this is the participation constraint of the high cost type. We don't have to worry about the participation constraint of the low cost type. Why? If this holds and this is positive, the low cost type could actually always produce this and make a profit. Therefore, we have to, by making sure she doesn't choose this, we have to at least give her that profit. Therefore, she will always want to participate as long as this holds. Okay, so we don't have to worry about the participation constraint of the low cost type. We also don't have to worry about the incentive compatibility constraint of the high cost type. The explanation for that is a bit more intricate. I've given it in the handout, I believe. We do have to worry about the incentive compatibility constraint for the low cost type, basically for the reason I just said. All right, whatever output I assign the low cost type, they're always going to be tempted. If we got them to participate, they're going to be tempted to do this. Okay, I haven't given you a full explanation there, but just believe it for now. What is the incentive compatibility constraint of the high cost type? We have to say, what will they get if they do what we want them to do? And that has to be better, that has to be greater, their benefit from that has to be greater than the benefit they would get if they accepted the contract, but then chose the contract element intended for the other type. So if they do what we want them to do, their utility is TLC, we get this transfer, minus theta, and in fact it's going to be the lower cost theta lower bar if you like, for producing QLC, Okay, so this is, you could think of this as their cost. So plugging in QLC into this here, you get this. We need this to be greater than their utility from producing the amount intended for the high cost type and being paid the amount intended for the high cost type. Okay, but that utility is not the same as the utility the high cost type gets from doing it, because the low cost type can do it at a lower cost. So this has to be greater than or equal to, let's make some space here. So this is PC high cost type is up here, IC low cost type is down here. It has to be greater than or equal to, all right, if they pretended to be the high cost type, they would get this THC amount, and then they would produce the amount intended for the high cost type, but at a lower cost. So they would then get, for producing QHC, they would get THC minus, this being their cost, QHC squared, but here they're producing it at a lower cost, so this is theta lower bar. Okay, here, generally we write this as theta lower bar, theta upper bar. Here I just gave you 1 and 2. So here, this value is just 1. So I'm going to replace this with the value 1, and also replace this with the value 1. Okay, they have to get more from doing what they're intended to do, and or at least as much from what they're intended to do from what they're not intended to do. Furthermore, these will both be binding constraints. Okay? So it's very clear to see why this one should be binding. Same argument as before. We want more quantity from them. We want to pay them less. So there's no reason to make this higher than it needs to be. But, just trust me on it now that this will be a binding constraint. So in fact, when the principal's optimizing, they're going to set these things equal. Okay, this will also be a binding constraint, and I could make an argument for this. Let's just trust me on it for now, that this will also be a binding constraint. Right? To make, if it weren't binding, you'd have to say, why would I want to make this strictly greater than this? Well, how would I make this strictly greater than this? By either reducing this, but I won't be able to do that. I'm choosing Q and T, so I won't be able to reduce, or I won't want to reduce this, and I won't want to increase this. I won't want to pay more than I have to the low cost type. And in fact, I also won't want to pay them more information rent than I have to, right? So this distance, the amount the low cost type gets from doing what they're intended versus not intended, this distance is actually sorry, that's not quite right. Okay, let's just assume that it's binding for now. Okay? Or just take on faith that this is a binding constraint. Okay, we have 2 constraints. This constraint does not interfere with this constraint, so this one will basically be binding. Okay, we know these are the 2 binding constraints. Now, I now have to solve this problem. Okay, I can plug in to the principal's maximization problem the binding constraints. What is the principal's maximization problem? Well, the principal gets to choose all 4 of these elements subject to constraints, and now they can't optimize separately because, in fact, these are interrelated problems. The greater the quantity I assign to the low cost type, the high cost type, the greater the rent I'm going to have to pay the low cost type. So in fact, what I want to consider is it's going to involve the probability of each type as well as the profit I get when each type arises. Okay, so let's set this up. So we'll call this U. I'm going to need space here. Okay, so let me consolidate this. If this is, all right, I'm going to get rid of the notation for the contracts here. We're no longer in the full information case. If this constraint is binding, then we have THC equals 2 QHC squared. So the amount the principal's going to have to pay the high cost type to get them to participate is going to be twice the square of the quantity they assigned to this person, just like before. What about this one? All right, let's simplify this, or reduce it to TLC on one side. The amount you'll have to pay the low cost type is going to be equal to, all right, I'm just going to move this to the other side. The amount you pay the high cost type minus, what's Q squared HC? Well, this is actually the cost of the low cost type of producing this amount intended for the high cost type. Note there's no 2 in front of it. So this is the amount, I'm not done here. This is the amount the low cost type would get in net if they produce the amount intended for the high cost type. So you're going to remember, you have to get what they actually do to be at least as valuable as that. So I'm going to also have to compensate them when they do what I want them to do for producing the amount I intended them to produce, QLC, and their cost of production is just theta times QLC. Theta is 1, so plus QLC squared. We can reduce this, in fact, or we can substitute in here. We know that THC, the amount we're paying the low cost type, has to cover her cost. So this is going to be 2 times QHC squared. So it equals to 2 QHC squared minus 1 QHC squared plus QLC squared, which simplifies to just QHC squared plus QLC squared. Okay, so this is the amount we're going to pay the high cost type to produce QHC. This is the amount we're going to have to pay the low cost type for producing QLC. Note, we're not just compensating them, we're not just going to have to compensate them for their cost of production, which in fact happens to be this. We also have to pay them an amount that increases the greater is QHC. The greater is the quantity we assign the other amount, and that has to do with the information rent. Okay, now we'll substitute this into, so we've determined what we're going to have to pay each as a function of the quantities we assign each, but we don't know what those quantities are. To determine those quantities, we have to look at the principal's optimization problem, and what is the principal's expected utility or expected profit? We'll call it utility second best for the principal. It's equal to, there's some typos in the answer here, sorry, just in terms of the notation. Okay, we've already determined what the T's are, so we're not choosing T's. These are determined by the constraints. So, but we don't know what the Q's are, so they get to choose QLC and QHC. Let me put H first to be consistent with what I wrote in the thing. To maximize the expected value of this, okay, I wrote in the notes, expected value, taking the expectation over each value of theta times its probability of, well, what Q do we get for the look, the QLC, minus what amount do we have to pay that theta, that Q, so that would be TLC. So I'm adding up the amount I get from the low cost type minus the amount I pay her, times that probability, plus the amount I get from the high cost type minus the amount I pay her times that probability. Okay? And in fact, let me make this simpler. I'm just going to replace this to save room here. Okay, this was just a very general expression, but in fact, I know these probabilities. So a third of the time, I'm going to get the low cost type. Sorry, maybe I should have kept the order the same. It doesn't matter what the order is, though. A third of the time I get the low cost type, because PL is a third. And when I get the low cost type, I'm getting Q low cost in output, but I'm paying them TLC, and we have an expression for TLC right here. So minus TLC Okay, but we can plug in for TLC, save a step. So we'll say minus QHC squared minus QLC squared. And then the remaining 2/3 of the time, I'm encountering a high cost type. Okay, remember, so this, just take a step back. This is the utility, this is the expected profit they will get if both incentive compatibility and participation is satisfied. So that when you see a low cost agent, when a low cost agent comes in, they accept the contract, produce QLC, and they're paid TLC. When a high cost agent comes in, which is 2/3 of the time, they produce QHC and they're paid THC, because both participation and incentive compatibility are satisfied. Okay, so 1/3 of the time I'm getting QLC and I'm paying TLC, which we've and 2/3 of the time I'm getting QHC and I'm paying THC, which is just the high cost type's cost of producing QHC. So that's minus 2 QHC squared. Okay. So now I'm going to take the first order conditions with respect to each of these. I'm going to find what QLC maximizes this and what QHC maximizes this. Okay, let's just assume we don't have to worry about, we have a concave problem, I set it up in a way that we don't have to worry about complicated matrices, second order conditions. Okay, so I take the first order conditions of this, I take the derivative with respect to QLC, so I will get, so derivative of UPR with respect to QLC, I get 1/3 so I get the output, my benefit increases at rate 1/3 because only 1/3 of the time do I actually get this agent. So I get the derivative with respect to this is 1/3 minus uh, 2/3 QLC. Why 2/3? Because I have to pay them at this rate. The derivative of this is 2 QLC, but the 1/3 also enters in there. So let me make it simple. So I get 1/3 times the derivative of the inner term. So 1/3 of the time I get the low cost type. My benefit from output increases at rate 1. My cost decreases, my cost increases, or the amount I have to pay in transfer increases at rate 2 times QLC. Okay, so in other words, that's obviously equal to 1/3 minus 2/3 QLC. First order condition, set that equal to 0. So I get QLC second best is equal to, just rearranging this, it's equal to third minus Q, I believe it's equal to 1/3. I don't feel like doing the algebra right now. Which, if you remember, this was actually the same as the first best. So in fact, the output we assign to the low cost type, when we don't know the types, through this mechanism, is the same as the output we assigned them when we did know their type. So there's no distortion of output for the low cost type. And we can see it when we look at this thing that we're optimizing. We're only trading off, okay, QLC only appears in the first line, right? It's weighted by 1/3, but that doesn't matter. It only appears in the first line. So when we do see the low cost type, we're trading off the benefit we get from their output from the amount we have to pay them, because the more we assign them an output, the more we have to pay them at a rate that is determined by the low cost type's cost. So there's no distortion of the output for the low cost type. But for the high cost type, it's different, because the high cost type quantity appears both here and here, because both we have to compensate the high cost type, and it affects the information rent we have to pay the low cost type. So if I take the derivative, I'm going to erase some of this to save myself some room here. If I take the derivative of this with respect to QHC, I get derivative with respect to QHC is equal to, well, it's going to affect the information rent, and I have to pay that information rent a third of the time. So a third times, what's the derivative of this with respect to QHC? In this case, well, yeah, here it's equal to a third times a third times -2. So in other words, a third of the time it increases the information rent at rate 2. So that's QHC there. And then 2/3 of the time I actually get the high cost type, and there, sorry, there's something wrong with this, it shouldn't be 2. It increases it at rate 2 times QHC. A third times 2 times QHC. And there should be a negative here, because there's a negative here. It's adding to the information rent, it's adding to the transfer you have to pay the low cost type. And then the remaining 2/3 of the time you actually get the high cost type, then as you assign more output to them, your profit increases at rate 1, and your costs increase at rate 4 QHC. I believe that's correct. Okay. Okay, and I've done the algebra in the example. This reduces to QHC second best is equal to 1/5. Okay, so 4QHC, I should say, 4QHC. Okay, so if we were just looking at this term, then we'd be trading off the costs and benefits when we assign this output, the actual benefit and the actual cost of the high cost type. But there's this other term. So that's going to lead us to QHC second best is less than whatever the first best, I can't remember off the top of my head, the amount that we assigned the high cost type. We just stored it downwards to minimize on the information rent. Okay. Okay. So we're asking for the optimal menu of contracts. We've determined the amount for the low cost type is 1/3. Now for high cost type it's 1/5. It's optimal in the sense profit maximizing. It's not social benefit maximizing. That's why we call it second best. And I could also substitute this in to get the transfers. So THC is 2 times QHC squared, so it's, yeah, whatever, 2 times 1 over 25, or 2 over 25, something like that. Okay. And is that stated? That should be stated in the answer here. Yeah, it's stated in the answer here. Okay. And we also compute the expected profits in a similar way as before. Sorry, Leo, where is it on 1/2? Did I make an error somewhere? QSB, sorry, you're right. Here's where I made a mistake, sorry. It's equals to, is that where it should have been 1/2? Yeah, sorry about that. Sorry about that. Okay. But this should have been equal to QSLB first best, and just double check that. QLC first best. Yeah, 1/2. Okay, good. All right, so let's try to finish this off, make sure we've answered this question, okay? So find the optimal menu of contracts for the principal to offer. I'm going to specify QHC is 1/5, THC is 2 times the 5th squared, QLC is 1/2, TLC is going to be, well, it'll be determined by this here, so it's going to be 1/25 plus 1/4. That's going to be the amount we're going to pay to T. Remember to check shutdown and pooling contracts. Okay, a shutdown contract would be one in which we assigned a high cost type's output to 0. A pooling contract would be one in which we assign both of them the same output, and if that, for that to be a positive amount, it has to meet the high cost type's participation constraint. So I believe the answer here is in the problem. Or is it not? It should be in the notes. Okay, so I should answer, I'm missing the answer in the notes on checking the shutdown contract. So if there's a shutdown contract, that means the high cost type does not participate, or I assign 0 output to the high cost type. Either is fine. So then I only need to worry about, I don't need to worry about the participation constraint of the high cost type. And if I'm assigning 0 output to the high cost type, and presumably not paying anything for 0 output, there's no way that the low cost type can do better by choosing the contract intended for the high cost type. Okay, so if I assign 0 output to the high cost type, I would only have to worry about one constraint. Anyone know which constraint that would be? Okay, can we calculate the value of the information rent from this somehow? Patrick asks. The information rent, it will be the low cost type's utility. Okay, we'll call that an information rent, and in the next question I get at why that is, or I've discussed why that is. That's the amount the low cost type would be willing to accept in exchange for revealing their type and going back to the previous case we discussed in which they got 0 remaining surplus. Okay, but yeah, so the low cost type's information rent will be the low cost type's profit in this case. Okay, so what is the low cost type or utility in this case? Well, I could calculate it specifically given these numbers. So I can plug in the numbers that I just came up with. So let's see, and in fact we do it here. So we clear up some space, just rely on that I have this stuff in the handout. So the low cost type's profit is simply TLC, second best, if you like, minus the cost, their cost of producing what they're asked to produce, which is theta, which is 1 times the QHC that we have assigned to them squared. The QHC we've assigned to them is the QLC, sorry, it says QHC, I meant QLC. Right, they're producing this, it's costing them this to produce, they're being paid this. The QLC we've assigned to them for this particular case is equal to 1/2. So this is minus 1/2 squared, or 1/4. And the amount we're paying them, TLC, we've solved for this numerically. It's 1/25 plus 1/4. So here their information rent will be 1/25. In the linear case, it was easier to, perhaps it was slightly easier to see this generically, what this would be, when we had cost increasing linearly. and benefit increasing at a decreasing rate, because then we just said, all right, we know their information rent would be the amount that they could get. They need to have at least as much rent as the amount that they could get if they pretended to be the low cost type. Okay, so we can actually see that here too. So if they pretended to be the low cost type, they would get the amount the low cost type is paid. Sorry, if they pretend to be the high cost type, they would get the amount the high cost type is paid, THC second best, and it would cost them at the low cost rate to produce it. And we know the high cost type was being paid the high cost types because the high cost types participation constraint bound, the high cost type was being paid no more than their cost of producing it. So in fact, this was just equal to the cost of the high cost type of producing T intended for the high cost type. So in other words, this is general. The information rent for the low cost type will be the difference in costs for producing the amount assigned to the high cost type. And we could plug that in here if we could have called this cost of producing Q is equal to theta Q squared. Okay. All right, so I think that mostly answers Patrick's question. What does the term binding mean? That's a bit of a precise mathematical term. Constraints either bind or they do not bind, essentially. Well, that's obvious. I can maximize something subject to a constraint. That means I can't just choose the highest point on the mountain. I have to choose the highest point on the mountain that is, let's say, no more than a certain latitude and longitude combination. It means I can't look at the complete set. I have to look at part of the set. Right? I can't say what's the best point in the circle. I have to say what's the best point in this circle that's to the left of this line, to the left and below this line. Okay, either if a constraint binds, that means that it matters. Okay, so suppose the best point in this circle was this point here. And I said you have to choose a point to the left and below this line. Well, this constraint would not bind because the point I would choose if I were not constrained is the same as the point I would choose if I were constrained. Okay, now suppose that perhaps this is the best point in the circle, and we I'm waving the hands a bit here, we kind of have things increasing in a monotonic way. Okay, so things get better as you move towards this best point. So in these general cases, like the ones we see here, when the constraint binds, so this is the point I would choose if I was unconstrained, the point that I would choose if I'm constrained will be a point that is on this line that is on the constraint line. In other words, it's not that I will choose a point over here, but if the constraint binds, I will choose a point that gets me as far as I can towards this constraint. So if a constraint binds, the constraint will be met with equality. So not only do I have to be below, not only will I choose to be below and to the left of this line, or it's an equality, sorry, I said below, I meant below or at or below and at or to the left of this line, I will in fact choose to be on this line. So if my constraint, if my IC constraint was that T minus theta Q squared must be greater than or equal to 0, in fact, I will choose T and Q such that T minus theta Q squared equals to 0. And if this is the case, that the constraint is binding, we can just plug it directly in and we get an unconstrained problem. Because the solution we solve for automatically imposes the constraint algebraically. And if the constraint is not binding, you can completely ignore it, which we did. So we had two binding constraints, which we plugged in, two unbinding constraints, which we ignored. Okay, could you explain how to check shutdown and pooling contracts? Okay, now let me give a set to think about this. Okay, shutdown contracts. shutdown contract means that, well, let's just talk about the case where I'm shutting down, quote unquote, shutting down the high cost type, okay? Now, in fact, as I believe I show in the notes, you don't have to check that separately. If the optimal constraint was, if the optimal contract involved shutting down the high cost type, then when I solved for the high cost type's optimal output in the previous problem, I would have obtained a negative value. And knowing that it can't be negative, we know that, well, at best it's going to be 0. Okay, if even the first unit assigned to the high cost type costs more in terms of both the amount you have to pay the high cost type and the impact on the amount you have to pay the low cost type times the probability of the relative probability of the low cost type, if even that first unit costs more than its value, you will assign 0 to the high cost type. But I can set up the shutdown problem specifically, okay? So, and I think I also have this in the notes. Max, the principal is going to be shutting down the high cost type, okay? So, when the high cost type comes, you get no output, pay nothing. So in fact, you only care about when the low cost type occurs, which occurs with probably 1/3. Obviously, this 1/3 will disappear when we look at first order conditions. Okay, so in other words, if I'm doing a maximum for the case of something that only occurs 1/3 of the time, all I need to think about is what is the best thing to do in the instance that that choice occurs. So in fact, let me get rid of the third for now. So all I have to figure out is, all right, how much output am I going to assign and what transfer am I going to pay when I get the low cost type? All right, so I get to choose QLC and TLC. To maximize, TLC minus theta lower bar, QLC squared, subject to certain constraints. But which constraints? Okay. As I just said, we're not demanding anything from the high cost type. So we don't demand the high cost type participate, nor that they choose a particular contract. We only have to worry about the low cost type. The high cost type is shut down. We're only really going to be offering one element to this contract. We're offering the amount, we're offering an amount and a transfer that we intend only the low cost type to accept. So we only have to worry about the participation constraint of the low cost type. And we know that that participation constraint is simply that TLC minus theta lower bar QLC squared, in this case, is got to be greater than or equal to 0. Okay? And we know that this is, in this case, we use the value of 1, so we just have TLC minus QLC squared greater than or equal to 0, or TLC has to be greater than or equal to QLC squared. By the way, this is the same thing we looked at in that first best case. We said specifically we can do separate optimizations when we know which type we're facing. So the only difference here is that we're offering a contract that we know, in fact, only the low cost type will choose, because if, well, we'll see in a sec, we're going to give them 0 utility, and if they get 0 utility, surely the high cost type can only produce it at a higher cost and would strictly get negative profit or utility. Okay, so the only difference here is rather than knowing which type we have and offering each of them a contract, but only one contract, we offer only one contract. We don't know who's going to come. 1/3 of the time we get the low cost type, 2/3 of the, and they accept the contract. 2/3 of the time we get the high cost type and they reject the contract. Okay, so again, we're going to maximize this subject to TLC greater than or equal to QLC squared. Well, this is bad for the principal, this is good for the principal. No reason to make this greater than this, so the principal will set TLC you want TLC shutdown equals to QLC squared. So they're going to just take, let's take the first order condition here. So TLC is QLC squared, so we get QLC squared minus theta lower bar is 1 minus, I obviously made some mistake here, hold on a sec. So we pay them the amount that it costs them to produce. You get Q, sorry, I see what I did wrong here. I set this up wrong. This is the agent's utility function. I meant to set up the principal's utility function. Sorry, I'm getting a bit hungry and tired. So the principal will get Q minus T, or QLC minus TLC. Okay, strictly speaking, they'll only get this when we have the low cost type. So they'll only get this a third of the time. But obviously in the maximization, this will drop out for the reasons we discussed. And we know they will set TLC equal to QLC squared, the low cost type's cost of producing it. So they're going to choose max. We've already eliminated TLC, so max subject to QLC, one third of QLC minus QLC squared. Take the first order condition, we'll get 1/3 equals 2 QLC. I believe, I'm sorry, 1/3 should be in the thing here. So we'll get, obviously this will drop out when we take the first order condition, so we'll get 1 minus 2 QLC equals to 0, or QLC equals to 1/2, which is the same quantity we assigned in the first best case, for the obvious reason that we were maximizing two separate problems. Now we're maximizing a single problem. The profit will be lower, perhaps, because we're only getting this a third of the time, and we're getting nothing 2/3 of the time. Okay? So I could check the shutdown contract. I could even say, what is the profit from this? So what would be the profit from this? Well, namely, it's going to be 1/3, because when I get the low cost type, a third of the time, I will get QLC, which is 1/2, 1/3, 1/2, but I'll have to pay something for that. What am I paying? I'm paying TLC, which is the square of 1/2, 1/2 minus 1/4, which obviously is equal to 1/4 times 1/3, so that's 1/12, which you can see will be less than the amount that we should have just computed for the separating contract case. Okay. Okay. 1/12 should be less, I believe, than 3/20. Is that right? Is 1/12 less than 3/20? Yeah, I think it is. Okay. So we could solve for it explicitly, but I knew this was going to come in general for reasons I discussed in the handout. When I'm solving for the optimal amount for the high cost type, I'm trading off the information. I'm saying, what is the amount where the marginal benefit is equal to the cost, both in terms of the cost I have to pay the high cost type and the cost in information where I have to pay the low cost type. When I'm solving that, right, I'm taking those things into account, and if the cost outweighs the benefit, I will then come up with an answer that's non-positive, and I'll know a shutdown contract is best. We didn't. We came up with a positive value for QHC second best, so we knew this was going to yield a lower profit. Okay. And the pooling, not pooling contracts, then if I had to do a pooling contract, if I were to do a pooling contract, then I'm saying I want both types to produce, but to produce the same amount. So what are my, what constraints do I have to worry about? Well, they both have to participate, but there's no incentive compatibility because there's only one contract I'm offering, but I actually this time want both of them to take it. This is never going to be optimal, at least in no situation where there's no menu costs, just setting up a contract, and there's only two types. And I discussed that in the handout, but so we would have to worry about the participation constraint
in theory, of both the high cost type and the participation constraint of the low cost type. But think about it. If we got the high cost type to participate, we had some amount T and Q that the high cost type was willing to accept, then surely the low cost type will be willing to accept that amount because they could produce it at a lower value, at a lower cost. So this would be the constraint we'd have to worry about. We'd set up the maximization problem subject to, in this case, T, we'll call it, if you like, T pooling, I don't know, T pooling minus, we care about the high cost, so 2 times Q, I don't like the way I've done this. Let's just say T, I'll put the T in the subscript. T pooling minus 2Q pooling, 2 Q pooling squared, cover the high cost types cost. You can see, for obvious reasons, this will be binding. You don't want to pay more than you have to. You want as much quantity as you can get. So we would have T pooling would equal to 2 Q pooling squared. And basically, we'd be doing the maximization problem based on the high cost types cost. You'll get the same quantity as when you optimize separately for the high cost type, but now you're getting both types to produce it, to produce the amount intended for the high cost type. You're going to get both types producing whatever we said it was, an eighth, I can't remember. All right, now, this gets to the next question. If the principal implements a contract in which both types produce the same amount, the pooling contract, will either type get an information rent? Well, will either type get a rent? Well, we're going to satisfy the high cost type's participation constraint with equality. They will get just compensated for their costs, they will not get a rent. But the low cost type will, of course, be able to produce this amount, which was the QHC from before, QHC, not QHC second best, QHC first best, okay, because we're optimizing as a separate problem, QHC first best, costing at rate 2 times output squared, or costing at the high costs rate, the derivative of that, costing at the high cost types rate, cost rate, and benefiting at rate 1. We're assigning this amount of quantity that is the efficient amount for the high cost type, a sub-efficient amount for the low cost type, and of course, the low cost type can produce it and make a profit, make a rent. They will get a rent. Do we want to call it an information rent? Well, that's debatable, because you won't actually, if you have one contract or one quantity that both are producing, you won't end up actually ever learning that information. The low cost type will never actually be revealing that information. Now, there's also a pretty intuitive reason why this will also never be, this pooling will never be an optimal thing to do. There's always going to be some benefit you could get by separating the types. But that's not what the question asked. Okay, so I've been doing this for about 2 hours. I have to finish up. I didn't go over all the questions I wanted to go over, so I will, there was one more that I wanted to go over, the price discrimination discussion. I've given you some links to that. Perhaps I'll put up another video covering that, or maybe you could give me some feedback on that and I could respond to it. Okay, so I hope this was helpful, and I hope it's helpful to those of you who watch it later. Let me know if there's anything needing further clarification, either here or maybe on the VLE. And yeah, I'll hope you have a good weekend. Or any quick questions before I finish? Put up some notes on the shutdown and pooling contracts. Cindy, I will try, if I have not already. My pleasure. My pleasure, Max. Okay, bye-bye. Take care. How do I finish this? Over here.